Hey there, YouTube family. Happy day to you guys. Say hi in the comment section. Hit that like for me. So today, what do we have going on in the markets? Well, we have the dollar. The US dollar index is going up, which we know is bad for stocks. And we have the US 10-year Treasury bonds are also going up, which is bad for stocks. And we know that the SQQQ, which is an inverse ETF that profits when the stock markets fall, it's also going up. It specifically trades against the NASDAQ and is measured against the QQQQ. So is this buyer's remorse? That's the big question I'm getting today. And what can we expect for tomorrow? I'm going to break that down for you guys. Let's go. Yesterday, we saw an absolutely incredible move in the markets. And if you were a risk taker and you had some cash on the side, it was an absolute profit-making day. I know a number of people, myself and my friends, who when they saw these big moves occurring, took a stab at the markets, put some money to work, and made some very good returns. Basically, after the markets printed an incredibly bad CPI report that confirmed runaway inflation, we got a magnificent rally. The Dow was down 549 points at its low, and then it turned around and it ultimately hit up 960 point high before closing at 828 points up for the day. That was an intraday 1,300 point move, which is absolutely incredible. That is an opportunity to make some money if you are ready and prepared. We talked about that, people losing their seats and you sitting down and taking your seat. The S&P saw its biggest trading range since March of 2020. There's a lot of volatility there. It basically means that yesterday was as significant of the market move, again, as to when the world thought that all commerce was going to come to an absolute halt because of a deadly plague that was affecting the whole world. That might have been hyper fear. All sectors ended the day positive. So one of the most common questions I got, which was very reasonable, is why did these markets move up when the CPI was so bad? Well, there's a couple answers to that. One of the number one answers is profit taking. And I know that there's a lot of people that still don't understand how this works. So when somebody shorts a stock, so what they do is they sell a position that they do not own, and they're essentially borrowing the shares from the exchange. So they put a sell order in on a stock that they don't own, and it automatically borrows the shares from the exchange. But the way that you close a short position and you take the profits because you are betting that you could get it at a lower price, the way that you do that is to buy it. And then the difference from when you shorted it to when you bought it is your profit. And so a great deal of what was happening yesterday is that because the markets did not confirm a downward trend, a lot of people began to close their short positions because they realized that if the market did reverse and go up, they would get stuck and they would lose all of that prime profit that they had made since the market has been falling down over the last couple weeks. In addition to that, the markets bounced because people got too negative too soon. And this is a very important point. It doesn't mean that the markets won't continue to fall. That's something we have to keep in mind. But what it can mean is that a lot of people believe that we have fallen too far, too fast, too soon, and that we have to get more data confirmation as to what's really happening before the market can continue to go down that additional leg. And so it doesn't mean that that won't happen. It just means that when people put money back to work, they believe that with the information and the data that they need to justify bigger moves down isn't there. So they put money back to work. After a strong market move like this, we have to take a step back and we've got to let the markets digest everything that happened yesterday. Right now, today is a digestion day. And I even told you guys that I had gone from being bearish and holding SQQQ. I had recommended that the day before. It went and hit my profit margin and exceeded it. And I sold it. I cashed it in and then it began to drop. And I bought TQQQ under $17 in the $16 range. I took a starter position in that, but it doesn't mean that the SQQ has not pulled back enough that we might flip it again and go back into the SQQQ, sell the TQQQ. I'm up $2 still on that as of right now. And we might find that we're going to push forward into the downward direction and that it's more profitable to hold the SQQQ. Today, we are vacillating a little bit between the two because we are trying to digest the move and get a confirmation. I think that today, by the end of the close, we often see the market decide going into the weekend whether it feels more bullish or is going to be risk off. And so I think we're going to see a lot as we move into the end of this day. I'm going to cover the Qs, the SPX, and the VIX in the charts today. But before I begin, I just want to acknowledge my trading community. I love the comment section where I see that you guys accurately answer questions that people give. And that really confirms to me that we are building a knowledgeable group of people that can feed off of each other and help each other. We're also in those conversations over on the MooMoo app, but without all the spam comments that get put in there faster than I can respond to anybody. In that environment, there is just text messaging communication, and I have to admit I like that. If you don't have MooMoo, it's an exchange. They offer you the full max 16-hour trade window, as well as 8 order types that you need to survive in markets like this, as well as a very high quality news feed. There's a link in the description of the video. You guys can join the conversation here on YouTube by hitting that subscribe, and join the conversation over on MooMoo by clicking the link in the description of this video. So let's talk about the VIX. If the VIX goes down when the markets go down, that is actually a bullish signal. It's like the bullish divergence or bearish divergence I talk about, because normally if the VIX goes down, the markets should go up. But if the VIX goes down, when the markets goes down, that is a divergence and is pointing to a reversal. That's what happened yesterday morning. So a lot of the smart money saw that this bearish move was not going to be continued. It's extremely important that you guys understand the VIX. And I want to remind you guys exactly what it is. The VIX measures volatility in the markets, and that's used to measure the concept of fear. I want to remind you guys all today that we are still operating in a very high VIX environment, which means that we're still operating in a very high fear environment. And the way that you should interpret that is that when fear is elevated, basically things can come along and spook the market. I want you to think about this. If there was a VIX which measured someone walking down a dark alley, right? And they were a little bit scared of their environment and they had to pass through to get to where they were going. And so they chose to go down the alley. And all of a sudden, somebody jumped out from behind of a trash can and yelled at them. And they screamed and they turned around and ran the other direction. That's kind of what the VIX is for the markets. The VIX measures the fear. So the fear is the alleyway, right? And then there's something that comes along like a data point that jumps out from behind the dumpster and scares them. So the data scares them, and then they have an elevated fear and they don't think rationally. They turn around and they run the opposite direction that is not the direction they want to go. Going forward and through the alley is going up. Turning around and going away from your destination is going down. And that's what the VIX measures in the marketplace for us. It tells us that all the participants that are essentially trying to go down the alley or in the up direction, going long, all those participants have elevated fear. And so that if anything comes along, some global economic fear or some news story or a company's really bad earnings or one country attacks another country, then that's this environment of fear. The market can get spooked. They will give up on going through the alley to the brighter days ahead. They're going to turn around and run the other direction and give up on their journey. That's how I want you guys to understand the VIX. And I want you to know that we are in an elevated fear environment. And so that's why you have to be careful and be risk off. You have to, and I'm going to break that down. We're going to talk about the SQQQ and the TQQQ because those are vehicles for hedging your investments. If you own a bunch of long stocks, then you may consider owning the SQQQ as a way of profiting if the markets flash down. You hold on to your long investments, but you can hedge some of your losses by having an investment in one of the inverse ETFs. I talk about the SQQQ because it's an easy one for people to understand. And if the markets get spooked and they fall, you can profit here, right? And then sell at a profit and then wait for the markets to come back up. And that way, you're not just wasting your time and losing value in your long-term investments. I hope that makes sense. So that brings us to the SQQQ and the TQQQ, and I'm going to jump into the charts to go over that with you guys. And I also want to point out a bullish view on the SPX. It doesn't mean that the markets are going up. It doesn't mean that I'm bullish. I just want us to examine both bullish and bearish environments so that we can get a broader, more accurate view of the environment. Okay, we're looking at the SQQQ. And yesterday I talked with you guys about the fact that we got a phenomenal profit-taking opportunity when it ran up to 69.55. But when it came all the way back down by the end of the day to below $60, it did create an opportunity to buy it again. So I am currently in both the SQQQ and the TQQQ. The SQQQ is a hedge against my other long-term investments. This goes up in profit when the rest of the market drops. And as we talked about that earlier today, the market is contracting from that big move that it had yesterday. But here's what I want to show you guys about the SQQ right now. We had this massive, large move up, which culminated into yesterday's move, right? And I want to compare that to some past movement in the SQQ. So let's go back here and let's look at this point. We knew this was a great point to buy. I called this just a few days after we got a confirmation. Now, how did I get the confirmation that this would be the bottom? Well, one, I was looking at a trend line, like you guys see drawn on my screen. Secondly, I was looking at the 15 EMA, exponential moving average. And when we had two candles that were above the EMA. Now you see the EMA in this chart. It's the red line that's running through all of the different candles. Okay, you see that red line? Okay, that's the EMA. And whenever I got a break with 2 days above it, like for instance right here, that was a confirmation to me that we were going to go in a bullish direction. And you see that over here, it went into a bullish direction, okay? And similarly, we're looking for 2 days of confirmation that this is going to break down. We didn't even get 1 day. The very next day, what do we get? A massive green candle that looks like it'll likely close over the 15 EMA. I know that some of this can be a little bit tricky for people that are new to it. I'm going to just take a different approach and I'm going to keep it more simple. After these big run-up moves that had these large wick candles at the top, it didn't just go straight down, did it? It actually continued in an environment, an elevated environment for a number of days before ultimately giving us a decisive move down. Let's look at this one. After we had this great big move up, it didn't just go straight down. Instead, it went into this environment where we retested the top a number of times before ultimately breaking down. And you see that right here, we had two full candlesticks that closed beneath the 15 AMA, which was a pretty good confirmation that this was going to go back. So we have these bullish confirmations on this. We had this position back, I believe it was July 18th or no, August 18th. And we've had this massive move up. And so what I want you guys to understand is that we are likely to stay in this environment. And so what this would mean on days that we come back, those very likely are buying opportunities for the SQQ, because we are likely to see some movement like this before we ultimately come back down. In this type of environment here, you can actually own the SQQ and the TQQ and trade them back and forth using that 15 EMA. I hope that was helpful. Feel free to ask me questions in the comment section. Okay, this is the SPX, which measures the S&P 500 index. And this is a very important point I want to make to you guys today. We have so many people compare the current environment to the recession, the 2008-2009 recession. And let's go ahead and do that then. If this is the 2008-2009 recession right here, and let's just look at the fact that when we broke beneath the 100-day moving average and came all the way down and hit the 200-day moving average, we did go down beneath it, and then we came back above it. And what did we do? We came back and retested the 100-day moving average before going lower. Now, a lot of people I haven't heard anybody talk about that, but let's look at where we're at right now. We obviously are in a downward move. We came and we broke through the 100-day moving average. We got into the middle of that environment. We came back up and we touched the 100-day moving average, but only in the last couple weeks have we actually tested the 200-day moving average. We have not gone up and tested the 100-day moving average after hitting the 200-day moving average. And if we were really going to confirm this downward trend and we were really going to be like 2008, we could easily come back up and retest that 100-day moving average after touching the 200-day moving average. The market could easily do that. And that would bring us all the way back to 4,200 on the SPX. Now, am I all bullish and telling you to go all in because this could possibly happen? No, but I think it's important to balance the bearish narrative, especially looking back on that 2008 environment, and realize that the market will backtest every move. So when the market broke through the 100, it backtested that 100, and then it broke through the 200 significantly. And what did it do again? It backtested the 200. Only after failing there did it have this massive move down. And I'm just going to point out over here where we're currently at, we haven't backtested anything. We have only backtested the 100 to confirm going down to the 200, but we have not backtested the 100 to confirm a bigger move down yet. And so we need to be aware that this market could easily move in this range until it attempts to backtest the 100 and fail before ultimately going down much further. It's important that we look at both sides of the trading coin and be balanced in our view and not get overly bearish. I've mentioned to you guys before that the bearish sentiment was at a record level of 45 weeks above the 60% mark, which means that 60% of all the traders were saying the market's going to go down. And whenever the market is that bearish, it often doesn't do what the herd thinks it's going to do. It sets up for a move up, and that's historical data. And I wanted you guys to at least see that bullish narrative. If we're really going to compare ourselves to 2008, then let's compare ourselves to 2008 and realize that right now we absolutely could go back up to 4,300 on the S&P 500, and then that still wouldn't mean that we were out of the recession or out of the bearish trend. It just means that we would be taking each level by level in the markets. That's all I've got time for today. We've got a big week ahead of us with big tech earnings. Hit that subscribe so we can keep this conversation going. Peace and blessings, my friends. I'll see you in the comments.